Tell us a little bit about your path. How did you get to Wall Street?
Oh, God, how did I get to Wall Street? The story of the financial crisis, outside of just housing, all the problems that the investment banks and the banks had, that was not an equity story. That was a bond story. That was a fixed income debt story. This was like the debt side of planet Earth. This is where I came in. JP Morgan invented something called a credit default swap. What basically that did was the balance sheets of all these firms got tied together in a spider web that was so complicated that nobody even knew where it began and where it ended.
I think that's a good segue to open it up to the audience.
What are the warning flags that you are looking at that indicate that the business has serious structural problems versus just temporary problems?
And now I'm going to tell you where the fraud was. I think what I'm about to tell you is the biggest fraud in human history. On October 29th, I visited Case Western Reserve University in Cleveland to speak at an event hosted by my friend, Ivy Zellman, the famed housing analyst. I spoke in front of 100 students about the financial crisis, the current market, and I answered a whole bunch of questions from the students. I thought it was a great event, and so we are going to share it with you.
So I'm so excited to have Steve. We've been friends for quite a long time. Steve Eisman, I would say, I didn't read his bio, but the introduction is that he is famous for calling the top of the housing market.
So are you?
Not as famous as you. My son corrected me that I'm definitely not as famous as you.
All right.
But the movie The Big Short, if you haven't had an opportunity to see the movie or read Michael Lewis's book, the character that stars in it, Steve Carell, is based on Steve's life. And we're excited to have you. So one of the things, Pete Carroll, who's a colleague of mine for going on almost 20 years, was covering Steve as a client for a long time, and I asked him to join us. And he's also taught my class in my absence, and he's a former Case alumni. So we're excited to have you up here as well. We'll do our best with the mics to share. But why don't we get started? Tell us a little bit about your path, your trajectory. How did you get to Wall Street?
Oh, God, how did I get to Wall Street? So I went to law school. I really loved it. And
where'd you go to law school?
I went to Harvard. And you didn't have to bring that up. And I clerked for a federal judge. And then I went to work for a big corporate law firm, and I hated it. I absolutely hated it. It turns out that to be a good corporate lawyer, you need to be exceptionally detail-oriented, and I am exceptionally not detail-oriented. So I thought I was having I thought I was going crazy. I managed to get a job on Wall Street as a junior analyst in March of 1991, and I was working in basically a converted closet, which is where they stuck me. I was working for three analysts who, as their junior, at Oppenheimer, which still exists to this day. I was sitting in my office, and it was like late summer, maybe early fall, 1991. And an investment banker walks into my office, who I've never seen before. And he says to me that Oppenheimer is going to bring public a company called Ames Financial, which is he says, a subprime mortgage company. And Oppenheimer does not have a specialty finance analyst, and the bank analysts don't want to cover it because it's not a bank. Do you know anything about subprime mortgages? So I said to him, well, I was a lawyer, and I did all this document securitization work for a company called The Money Store, which back then was a fairly famous subprime mortgage company. And without missing a beat, he said, "You're hired. You're the analyst." Now, what I didn't tell him was that all I did was proofread. I actually didn't understand a single word that was in the documents. And that's how I got started. And I got promoted. I started covering some mortgage companies. And after I covered a couple of mortgage companies, I decided they pretty much let me cover whatever I wanted. And I didn't really know anything because I had not gone to business school. Nobody had taught me how to model. So I was looking around, and I discovered the asset management industry, the mutual fund industry, which a lot of the companies were public. And I swear to God, the reason why I decided I was going to pick up coverage of the mutual fund industry was that they're the easiest companies to model on the planet. It's just, all you do is you just make an assumption about how much the assets are going to grow. You average take an average, and everything on the income statement is a percentage of the average assets under management. The model takes like 2 seconds to make. So since I didn't know anything, even I could make a model out of this. And so I wrote this report on the industry, and then over time I picked up more and more coverage, and I learned, I taught myself, I learned really how to model. It took a long time. I did that for about 10 years. When I was done, I was covering the subprime mortgage industry, the subprime auto industry, Fannie, Freddie, Sallie Mae, the asset management industry, the investment banks, and like a hodgepodge, credit cards, a hodgepodge of other things. I covered a lot of stocks because I wanted to learn.
And post that, how'd you go to the buy side?
So then at the end of 2000, I resigned and I went to a large hedge fund where I was the financial services analyst. And there I picked up the banks, which I had never covered. And I picked up the entire insurance sector. You could live without the insurance sector, by the way. And I did that for 3 years. And then at the end of the third year, I got recruited by a company called Front Point to run a financial services hedge fund. And so I joined them in 2004. I did that from 2004 through 2011. That's where I, got my fame. Eventually I ended up at Neuberger Berman, long only side. Did that until last year. And now I'm not a professional investor anymore. I just invest for myself, and I'm podcasting, which I really love.
It's a great podcast, really. Love it. And when you think about that trajectory, and we'll get to the Big Short and the call, and thinking about buy side versus sell side and your experiences, is anything from differentiating the two experiences that stand out between the two?
Well, the sell side is very different from the buy side. So the sell side, and there are different versions of the sell side. So one version, which I think is the most common, which you and I did not do, I call this the concierge version of the sell side, meaning you're management's friend. You are not going to write anything that's going to anger management because you want to bring managements around to the buy side like a concierge, because the buy side pays the sell side often for access. So most sell side analysts don't want to anger managements by making a negative call. So they're always pretty positive, or at worst neutral. Your professor here did not adhere to that model, believe me. Neither did I, but it's a harder path. The buy side is a quieter role generally. You're just trying to pick stocks and make money. So it's a different skill set. For most sell side analysts, being a good writer, being a good speaker is very important. For the buy side, that's not just necessarily important at all.
Mm-hmm. And you think about pivotal moments when you were at Front Point, building your team, the work that you did, was it relying on the sell side, or were you doing your own work as well?
We always used sell side research. We used you a lot.
Yeah,
so
I know.
Ivy was my total go-to person on housing.
Thank you.
I didn't pay attention to anybody else. But the story of the financial crisis was outside of just housing, where all the problems that the investment banks and the banks had. That was not an equity story. That was a bond story. That was a fixed income debt story. Most equity analysts don't really know the debt side. And this was beyond just the debt side. This was like the debt side of planet Earth. So, to really understand what was happening, you needed to understand what was happening in the securitization world. You needed to understand what was happening in the structured finance world. So we had to develop contacts, which we did develop within investment banks, but it wasn't your traditional sell-side equity analyst. I mean, I'll give you an example. One of the best bank analysts out there over the years is a guy named Mike Mayo. He's excellent. And at that time, he was at Deutsche Bank. I remember it was like May of 2007. Bear Stearns had a hedge fund that invested in subprime paper, and it blew up. It was front page. It was big news. And I remember Mike Mayo and I were talking, and he says, I just don't understand what's going on. And I said, Mike, get in the elevator, go down 3 floors, and go talk to Greg Lippman, who got played by Ryan Gosling in the movie, because he worked the same company as you. He knows everything. But most of the equity analysts, eventually they figured it out. But at the outset, this was so outside of their experience
Right.
that at first they didn't even know who to call. Eventually they figured it out, though.
Yeah. And maybe just for setting up the big call of Big Short, some of the things that we all saw in the movie, but doing the due diligence and going to conferences and talking to people like Danny and Vinny went to
Right.
Vegas and, walking around the securitization conference, or there are things that, there are not necessarily one moment, but it took a long time to build a conviction.
There were two parts really to the story. There's '07 and there's '08. The '07 story was, it took me a while to figure out that literally the entire mortgage fixed income edifice was basically on one assumption, which was that housing prices can't go down on a national basis. I remember, I forget when, it was probably sometime in the spring of '07, early spring. We had a meeting with the head of research of asset-backed securities at Bear Stearns. It was just us, me and my team, and him. And we just beat the shit out of him in this meeting. And he was upset because he thought it was a bad meeting. We said, no, we thought it was a great meeting. But he said in the meeting, he said, housing prices in the United States have never gone down on a national basis since World War II. And I said to him, is that like a law of physics? Because he honestly believed that it was like a law of physics. But once you realize that the underwriting standards had gotten so bad that it was going to cause housing prices to go down, that led you to places that nobody else was going to go.
Mm-hmm. Yeah, I remember, we had a lot of fun, even though it wasn't fun because we were lone rangers, but it was keeping our sanity by having each other to talk to and the other few that were out there. But
people thought we were crazy.
No, they were. In fact, at Credit Suisse, our head of strategy, head of economics, they'd have these group meetings. They'd be like, home prices can never go down.
Never
go down. Same thing. That was all what it was based on. But obviously they were all wrong. And when was the moment of vindication for you?
When was the moment of vindication? I think the moment of vindication was August of 2007. So, back then my kids were little and we used to go to Nantucket. We used to rent a little house in Nantucket every summer for 2 weeks. I remember in the first week, there was some really awful news in the mortgage market. And then I remember in the second week, my wife and I were walking on Main Street. And she turns to me and she says, there's something very odd. And I said, what? And she goes, where are all the men? And I said, oh, they must have gone back to the street to watch The End. That's when I knew.
Mine was when New Century filed.
Right.
That was March of '07.
I knew all those guys.
Did you really?
Yeah, New Century, that was one of the biggest subprime mortgage lenders.
Right. Yeah. Well, let's turn to the class and let's see what our students...
But before you do, let me give a little lecture on the financial crisis.
Please.
I'll give you the 10-paragraph version of the financial crisis. Because I get this question all the time. Like, what caused the financial crisis? So it's really 4 things. If you get these 4 things, you get the whole thing. So 1, too much leverage. 2, big asset class blows up, subprime mortgages. 3, systemically important firms own the asset class. And 4, derivatives. Now, if you know anything about economic history, every single financial blow-up has had the first 3, which is too much leverage, big asset class blows up, and systemically important institutions own the asset class. The only difference about the financial crisis was the role of derivatives. So I'll just run them through quickly. So on the too much leverage point, this is where people who get PhDs can blow up planet Earth, okay? If you're a carpenter, there's only so much harm you can do. You can make bad drawers, but PhDs can blow up the planet. So what do I mean by that? Between 1997 and 2007, leverage in large financial institutions more than tripled. Tripled. But the reason why it tripled was because of something very intellectual, which is you could have 2 banks that have exactly the same amount of leverage, but one bank makes very risky loans and one bank makes very unrisky loans. So the financial system over many, many years decided to marry the concept of risk and leverage in a concept called risk-weighted assets, meaning every single item on your balance sheet gets risk-weighted. And to make a long story short, the way capital ratios or leverage is computed for regulatory purposes, it's always done on a risk-weighted basis. It gives banks an incentive to load up on stuff that has very, very low risk weights. So when I said between 1997 and 2007, leverage tripled, it tripled on a pure math basis. But on a risk-weighted basis, leverage was flat. And the institutions only thought of their leverage on a risk-weighted basis. So these companies like Lehman Brothers, they literally thought they were no more levered than they were in 1997, even though mathematically they were way more levered. The flaw in the system is that all the risk weights are based on history, how much losses a certain asset class has, and underwriting standards can change. But by the time they change and the losses show up, it's too late. So that's part one. Part two is subprime mortgages blew up because the underwriting standards just absolutely went to hell. And part three, and here's the most ironic part of the story, is that systemically important firms own the asset class. Now, if you would talk to the securitization desks in 2006, they would have told you that this paper is going to go bad. But they all thought that they were going to buy it back on the cheap. But what happened was they produced so much paper starting in 2006 that there weren't enough investors on planet Earth to buy it. So the securitization desks went to their own firms and said, why don't we keep some? Because after all, it's rated AAA. How bad could it be? And that's why when the crisis started to happen, all these firms woke up owning tens upon tens of billions of subprime paper. That's two. That's three. One, two, and three. So here's the only difference, derivatives. So this is where I came in. But JP Morgan invented something called a credit default swap in the 1990s. So what's a credit default swap? Let's imagine you're an institution and you own $100 million worth of GE debt. You just bought it, just got issued, it's 5-year paper. And it pays, let's say, I'm just making up a number, 6%. All you can make is 6% per year. That's it. If, God forbid, GE, in some unlikely scenario, were to go bankrupt, you just lost your basically $100 million. So that's your nightmare scenario. So you want to basically buy insurance. So you call Goldman and you say to Goldman, I would like to buy a credit default swap, which is insurance, on $100 million worth of GE paper for 5 years. What will it cost me? And Goldman says, 50 basis points, 0.5%. So you say, done. There's no screen, there's no trade, this gets put in a ledger. And so what happens is GE pays me 6%. I send Goldman 0.5%. And if, God forbid, GE goes bankrupt, I'll oversimplify, Goldman writes me a check for $100 million. That's a credit default swap. Now, my individual risk in GE has just gone down enormously. But notice something. For me to get paid $100 million, Goldman has to be in business on the same day that GE goes bankrupt. So my balance sheet is now tied to the health of Goldman Sachs' balance sheet. Now, this is just one credit default swap. Now, most credit default swaps back then, and we're talking probably trillions, were done in between systemically important firms, like between Citi and Deutsche Bank. And so what basically that did was the balance sheets of all these firms got tied together in a spider web that was so complicated that nobody even knew where it began and where it ended, which is why the government bailed out AIG, because AIG sold about, I can't remember how much, 50 to $70 billion worth of credit default swaps to the street. And if AIG had gone bankrupt, the street would have been out of pocket billions. And that's why the government did bail out AIG. That's my short dissertation on the financial
No, it's very
crisis.
helpful. I don't think a lot of people understand credit default swaps, so even the term doesn't really fit with the idea that it's insurance. I think that was
Right,
really.
but it's definitely insurance.
And, the asset-backed security guys, they did know the paper was bad, and Credit Suisse had a pretty good credit asset-backed group. But when you think about the credit default swaps, who would have been analyzing it as the asset-backed guys? Who knew about the credit default swaps? Because you
Well, the credit defaults was what I did.
right.
When you short subprime paper, you were entering into a credit default swap with Goldman or Deutsche Bank, where you were paying them, like for example, I would go out and I shorted the New Century 2006-4 triple B minus tranche. It cost me, I did let's say $10 million worth. It cost me 3% per year. That was a credit default swap.
Right.
And but by the way, whoever I did the trade with, Goldman or Deutsche Bank, took my cash and made that into a CDO.
Which is?
A collateralized debt obligation, which is like one step removed from the asset backed,
Right.
which made the whole crisis even bigger. That's another story. I'm going to put out a master class on it one day. You can all listen. We'll go into it in detail.
Well, I think that's a good segue to open it up to the audience. So let's see. Questions? We can pass this around, I think. Pete, want me?
Just while we're on the topic, when you did CDSs, did you think that there was a probability that Goldman would go out of business?
Well, there was definitely a point where I thought everybody was going to go out of business. That was in September of '08. Everybody was literally on the edge. They all would have gone out of business if the government hadn't stepped in. Maybe J.P. Morgan would have survived. Everybody else would have gone under. I mean, Morgan Stanley was probably 24 to 48 hours from going under after on that Lehman weekend.
So did you think, should I be buying insurance for my insurance?
Well, at that point we were scared to death because, if everybody went out of business, we were going to go out of business too.
Thank you, Steve. I was going to ask, was no one looking at the distributions? Like now,
What do you mean distribution?
like when people look back at the financial crisis now, everyone analyzes the distributions, and it's obvious that there's fat tails and that there's a black swan event coming. Was there no quants looking at the distributions of the returns, the risks, seeing that there is fat tail probability, it's not normally distributed, and there's a potential for something going bad here?
I mean, I don't talk to quants, so I have absolutely no idea what the quants were doing. I can only tell you that the fixed income people themselves mostly missed it because they had been making so much money doing this for so long. It was sort of unimaginable that it could go bad. And most of the equity people missed it because it was a fixed income problem and they didn't understand the nature of the fixed income problem. I remember I forget, it was sometime in '07, a hedge fund buddy called me and he said, have you ever heard of anything called a SIV? So the SIV is a structured investment vehicle. Long story. Okay. And I said, no, but I think I'm going to have to find out. And it turned out that this was something that the big banks had created basically to offload stuff on their balance sheet, which they would still have risk for, but it would be off balance sheet. This was all stuff that used to go on that was completely that the regulators didn't even know existed, and so I never thought of this as a quant tail risk problem. I thought this as a real fixed income debt problem.
But even the equity analysts that covered Fannie and Freddie didn't get it. With respect to a lot of their programs like Fast and Easy and all the crazy underwriting was ignored because everybody was making too much money.
That's right. I mean, look, when you make a lot of money for a very, very long period of time, it's hard to imagine that it can go bad. I think that's just human nature. So, people in the fixed income world had made fortunes forever because housing prices never went down. So it was just unimaginable.
Steve, how did you deal with the timing of when the trade was coming to fruition versus, gosh, I know we have conviction in this theme and this idea. We have done a ton of work on it, but it didn't immediately implode.
So I actually
right?
got lucky. In the movie when they show the scene where Ryan Gosling shows up, that was like the late spring of '06. We actually didn't do anything till October of 2006. So we started putting on the trade very late, and we started small. Then I went to Vegas in January of '07, and then I came back with a lot of conviction, and I doubled or tripled the investment. And then things started to go bad pretty quickly. And then there was sort of like this very funny window. There was a period of March, April, or maybe April, May, I can't remember. It was definitely April, where the market rallied and we put on more. Now, this is where covering specialty finance really helped, because one thing that I learned over the years is that people get their tax rebates in the spring. So credit quality always gets a little bit better in the spring because people have cash to pay down some of their debt. For some reason, the fixed income world didn't seem to know this, and they thought this was real, and so the market rallied. But that was the only time that we had any problems in terms of pricing. But there were other people who were in the trade, like Burry. He was much earlier,
Right.
and he went through a lot of pain before succeeding.
Don't be shy. I know we got a classroom full of smart people.
Just before we go to the questions, is that the home builders, which were really the nucleus of what we started seeing as, silly underwriting and bad practice, business practices, that was in '05 when it really started. And I think there were early signs, but a lot of people just ignored those signs. And I think that it was someone like you and your team that took it a step further.
Well, credit really didn't start to get bad till '06. By '06, the underwriting standards had completely evaporated. And so, really the canary in the coal mine was that if you looked at the securitization data, which by the way comes out every month, you saw that by kind of like the summer of '06, the loans that were securitized in early '06 were starting to go bad very, very rapidly. That's when we knew that the game was over.
Well, also the negative AM, like the options were reset. That's also what caused it.
So my question is more about insurance. And do you see similarities with insurances nowadays backing private credit and credit default swap to the subprime mortgages?
I'm sorry, could you just repeat that? I'm not sure I got that.
So do you see similarities with the insurance with
with private credit owning insurance companies?
Yes. To the
credit default swap. People have been talking about this for years, which is that private credit has really grown enormously, and some insurance companies are now owned by companies like Apollo and KKR, and is there risk there? And I don't have a good answer for you because I just don't have there's just not enough data out there other than to say that it's grown enormously and that private credit owns insurance companies. But I just don't have enough data to have an opinion one way or the other. I mean, you can make a nightmare scenario, but nothing bad has really happened yet. I think, when one day we'll have a recession, we'll find out. But until then, I don't have an opinion about it one way or the other.
I probably don't need a mic. Kind of more just with the government and those regulations that they've started imposing on banks. I know there's a lot of kind of discourse about people's opinions on that. What do you think, really, even with the Silicon Valley Bank failing and stuff like that, what do you think the effect of the government and the new regulations after the financial crisis has been on the banks?
I'll just repeat the question. What do I think the impact of change in regulations on the banks post Dodd-Frank? I mean, the changes in the banks, well, we could talk about Silicon Valley, but the changes in the banks have been massive. So Dodd-Frank created a new position in the Fed called Vice Chair of Financial Supervision, which is a fancy term for chief bank regulator. President Obama never appointed anyone to the position, but it was held de facto by Fed Governor Daniel Tarullo, who may be the only great bank regulator in the history of the United States. And through the annual stress tests, which you read about, leverage in the banks got cut by more than half. And even within that leverage, he made them cut off the risk tails. So I think all the extra risk is in the private credit industry. But like I said, I got no data to say there's a problem. So I seriously, I mean, to give you an example, Citigroup was probably levered at least 35-1 pre-crisis. When he was done, it was levered 10-1. That's like the distance from Pluto from Pluto to the sun. So I do think that the banks are basically safe. The Silicon Valley debacle was not a capital problem. It was a sort of unique problem where when rates were cut to zero, Silicon Valley had a very interesting business model, which is they basically took in all the money from Silicon Valley and they bought treasuries. That's all they did. And so they just made that spread. And when rates were cut to zero, they decided that they didn't want to miss earnings estimates. So they went out and they bought a whole bunch of long-term treasuries. And then rates went up because the Fed raised rates. And so they had massive mark-to-market losses on their bond portfolio, such that their equity actually was negative on a mark-to-market basis, which is not the end of the world for a bank, as long as you don't have to sell. If you don't have to sell, eventually the bonds are going to, it's treasuries, it's money good. So eventually the government will pay you back and you get your money back. You just don't make as much money as you would have wanted to.
That was the panic.
Well, so that's the point. The problem that they had was, if you look at the deposit bases of Bank of America, for example, it's all over the place. It's consumers, it's high-end consumers, it's mid-level consumers, it's corporations, it's international corporations. It's very diversified. Silicon Valley had basically one kind of customer, venture capital. And what happened was when the Fed started raising rates, the market went into a correction. But the stocks that went down the most were the high flyers with no earnings. Those stocks went down 70 to 90%, literally. That's the type of company that venture capital owns privately. High revenue growth, negative earnings. So if the public markets are down 70 to 90%, that means that the private markets are basically down 70 to 90% too, and these companies can't raise capital anymore. And if they can't raise capital, they have to start drawing down from the bank the money that they've already raised to fund their negative cash flow. As that cascaded, Silicon Valley was forced to sell bonds, and that's what put them out of business.
Wasn't it Peter Thiel on a conference call said to everybody, take your money out? That really caused it.
Well, he did say that, but I think it would have happened anyway. Yes.
So my question kind of goes off of the regulatory theme. I was wondering what kind of regulations were placed at the underwriting level, so the bad business practices level, and what are those regulations still in place, and what kind of safety nets are there for those regulations in the case of a administration with an agenda for deregulation?
I mean, Tarullo made them just stop underwriting some of the riskier stuff. There are no subprime mortgages underwritten in the United States today. None. I mean, I shouldn't say none. Maybe there are two. I mean, there is no regulation about underwriting that I know of. The real regulation of the bank is via the annual stress test, where what happens is the banks are like given an exam. And the exam is, here's a very draconian economic scenario. Tell us how much money you'll lose and how much capital you'll have at the end. And you have to have above a certain level basically to pass the stress test. That's the binding constraint on banks, is the annual stress test. I mean, do I think this administration is more lenient than past administrations? Yeah, on the margin a bit. I think one thing that is going to happen, and I actually think this is necessary, I think we need an M&A wave in banks in the United States. We haven't had an M&A wave in regional banks in the United States since the 1990s. And the reason why I think we need it is it costs more to be a bank because of regulations, and because of the cost of technology, the cost to play is much higher. And so the larger banks keep taking deposit market share because they can afford that. And I think we need a big M&A wave so that we can have more banks that really can compete with JP Morgan. That's what I think is coming. It's already started. I mean, I'll give you one example. Comerica recently got bought out by Fifth Third. On the day that Comerica got bought out, the stock went to $80. Last time Comerica's stock price was $80 was 1998.
Just to switch gears a minute, and this can open the questions, really more current situations we're in right now. As you think about the Fed cutting today and the likelihood that we could have the Trump administration starting to, control the Fed, just thinking about, the consequences of continuously giving the patient who's dying more drugs. Like, at what point, the way the Fed is responding, it's like we can't have a recession. It's almost like we're on crack and it's going to just continue. Just your perspective.
Look, I think the institution of the Fed is a lot stronger than the press likes to get hysterical about. I mean, the Fed cut today 25 basis points. Maybe they'll cut again. This is not going to be a massive cutting scheme. President Trump will appoint someone else sometime next year. Even that person is not going to go crazy. So I'm not particularly worried about the Fed. I'm really not. Hi, Steve Eisman here. Some people are great at giving gifts. I'm not one of those people. And I'm not talking about expensive gifts, but thoughtful gifts. Gifts that show you are really thinking about the person. Finding Uncommon Goods has been a lifesaver for me. When you shop at Uncommon Goods, you're supporting artists and small independent businesses. Many of their handcrafted products are made in small batches. So shop now before they sell out this holiday season. I did. I have a good friend who loves football and is a big Giants fan. I found this great gift of Giants coasters on Uncommon Goods. This way, we get to watch the game next time and not ruin his furniture. I think my friend is gonna love it. And with every purchase you make at Uncommon Goods, they give back $1 to a nonprofit of your choice. They've donated $3.1 million to date. So if you're looking for gifts, check out uncommongoods.com.
Go ahead.
Thank you guys both for being here. It's a slightly less technical question, but you said people were calling you crazy. How did you, like you said you had the conviction, you did your research, but how did you cut out that noise and continue to stay strong and just deal with that from an investor standpoint?
It was a lot of anxiety.
Weren't you watching Space?
I'm going to say that. So I had a little office off the trading desk, and I had a TV, a big screen TV in my office. And lunchtime, I used to watch Star Trek Deep Space Nine, because it was always on at noon. And so I'd have my lunch, and it was my favorite Star Trek series. And that was one way I reduced my anxiety, because let me tell you, it was a lot of anxiety.
But what allowed you to stay grounded? I mean, we could talk about that, how I stayed grounded, you stayed grounded.
The way I stayed grounded was, thankfully, the securitization world does a massive data dump every month, middle of the month. It takes 2 days, and literally every single securitization in existence reports every single piece of credit data you could possibly imagine. So it was like Moses coming down with the tablets every month, and you'd look, and we would do a massive, data analysis, and every month we'd say, still getting bad. So that was the thing that gave us the conviction that we actually had monthly data.
I would just say, to add to that, it was also clear from the underwriting at the consumer level that consumers were obtaining mortgages. I remember being in Cleveland and meeting with a mortgage lender on the east side and having lunch, and they just signed a loan for a young person who just finished law school, and they didn't have a job. And I said, well, how can they buy a house then? Oh, I don't really care. We just sell it to Fannie and Freddie. They have something called the Fast and Easy program, and you don't have to prove documentation for your income. And so it was conversations like that and talking with builders that were selling to investors. We actually did a report do you remember Investors Gone Wild? Well, we quantified how many investors were buying houses. And so there was a lot of, call the house of cards, there was a lot of pieces and elements to it. But you just had to get on the phone with anyone in the industry, in the ecosystem, and you knew the craziness existed. And that helped me stay grounded, talking to the operators in the market.
So along those lines, how did it get that bad with the underwriting standards getting close to zero with liar loans? And just how did it get there? Was it political pressure or
No,
something?
it wasn't political pressure at all. So loans don't go bad overnight. It takes time. So, if you go back to like 2002, 2003, if you're a lender, the way you think about lending is you lend to what's called a risk-adjusted yield. And what I mean by that is you take the interest rate that you charge and you subtract from that the assumed your projected losses that you think are going to happen. And one from the other is your risk-adjusted yield. So we'll call it 2002, 3, 4, delinquencies actually were better than expected. The economy was good. You were bringing in an entire new class of people owning homes, so housing prices were going up, so people are not going to default when housing prices are going up. So the lenders basically would look at their books every year and they'd say to themselves, we were too tight. Because it looks like the losses are coming in so much lower than we expected. We can open the spigot, let's say double our volume, triple our volume, and achieve our risk-adjusted yield. We make a lot more money. So basically from 2002 on, every year, things were coming in better than expected. They just basically kept loosening underwriting standards until you got to like 2006, where literally the underwriting standard was can you breathe? That's basically what happened.
I would add, too, I remember it was like yesterday. It was when Alan Greenspan came out in 2004 and said that he encourages consumers to use ARMs. And that began the lending entities to say, let's give short duration lending to anyone who needs it. That's where we got into option arms, negative AM. But it was Greenspan. I blame him and the credit agencies. But
that's another story.
Just a separate question then. Conviction-wise, you said you came back from Las Vegas and you doubled and tripled the position. Was it the largest position of yours? Did it become the largest position, or do you have others?
We basically ran two books. We ran a credit default swap book of this stuff, of shorting subprime paper, and then I had a whole equity book, long short. So I ran them together. It was a sort of a very weird experience because, the equity book would obviously price during the day, and so you'd know what your P&L was throughout the day, and then like an hour after the market closed, we'd get the prices for the credit default swaps. So I always thought of the two books as being separate from one another, even though we did run them in tandem.
But it was all the same reasons. You were shorting the equities while you were also...
Well, so this is part of the story that didn't come out in the movie. What basically got us into this was we were like short New Century, which was this very large subprime mortgage company that was a REIT. It had a yield of 20%. That's what the yield was. So you were shorting a stock where you were going to have to pay 20% just for showing up. And then, by the way, the cost of it was not a liquid stock. The cost of borrow was an additional 20%. So you couldn't short that much. So here we had this position in New Century where literally it cost me 40% to short the stock. And then when in the movie, when Lippman shows up to explain to us the structure, basically the way an asset-backed security structure works, it's like a building. And losses are like a flood. And they roll up. And so the bottom floor was like something they call the equity residual. And that was either held by New Century or a hedge fund. And that was like 3% of the building. And then the next floor was like cash. That was like another 3% of the building. And then the next floor was rated BBB minus. And that was 3% of the building. So if losses got to 9%, the BBB minus got wiped out. 3, 6, 9. So I was sitting there, the epiphany that I had was New Century owns the bottom floor. It's costing me 40% to short them, and they own the bottom floor. I just go 2 floors up, it's going to cost me 3%. So 40%, 3%. I learned in school 40% is a lot more than 3%. So I decided I'm going to go 2 floors up. That's basically how I got into this thing.
You guys started talking about blame, and I kind of wanted to understand who to point the finger at. I mean, was it the mortgage lenders giving out mortgages to people that were unable to pay it back? Was it the ratings agencies that were still giving AAA plus to everything?
Yeah.
Was it the fixed security analysts that didn't know what was going on? Was it the banks that were leveraging?
So you could stop. The question is who to blame. God, we could talk about this forever. You know, the lenders lost their minds. Wall Street lost its ethics. And the ratings agencies lost their ethics because they got paid 3 to 4 times more to rate a subprime securitization than they got to rate everything else. And now I'm going to tell you where the fraud was. I think what I'm about to tell you is the biggest fraud in human history. Nobody went to jail. So if you are a Wall Street firm, and you're securitizing subprime paper, what you do is you approach one of these originators like New Century, and you say to them, I will buy any loan from you that has the following characteristics. You know, loan to value of X, debt to income of Y. That's your underwriting grid. So New Century calls you up and says, I got $1 billion worth of loans for you. And you're Goldman, you're Deutsche Bank, it doesn't matter. You buy them. And you pay a premium. So you pay, let's say, 2 points above par for the $1 billion. On the day that you have bought the loans, you have bought them blind, meaning you have absolutely no idea what's in these mortgage files. New Century just sent you $1 billion worth of loans. Now, the average size of a subprime mortgage back then was something like $200,000. So that's 5,000 loans. Now, you cannot securitize 5,000 loans and tell the investors, we have absolutely no idea what's in these files. So literally almost every single Wall Street firm hired a company called Clayton Mortgage. Do you know this? She knows this. Of course she knows this.
No, I know of Clayton.
Yeah, so they all hired Clayton Mortgage. It was a subprime mortgage due diligence company, amongst other things. And they'd all give Clayton Mortgage the same exact marching orders. Pull a statistically significant sample and go through the files. Now, a statistically significant sample would be like 10%. So it's 5,000 files, 10%, 500 files. And Clayton Mortgage would go through 500 files and would give a report to the Wall Street firm. Now, the reason why I know this is I saw the reports, and the reason why I saw the reports is that the Financial Crisis Commission disclosed the reports. And starting in 2006, when the underwriting standards went to hell, the reports start to come back very bad. 10, 20, 30, 40% of the sample is outside of your grid, meaning this debt to income is ridiculous, the loan to value is too high, whatever. Now, contractually, you, the Wall Street firm, have the right to put back to the lender any loan that you discover upon due diligence that is outside your grid. So this is what happened. So it's $1 billion of loans. Due diligence is on 10%. Let's say 30% is no good. That's 30 million out of $1 billion. So the Wall Street firm would send back the 30 million, get back 30 million plus the 2 points that it paid. Now it's got $970 million worth of loans left. First question, how many Wall Street firms ordered due diligence on the remaining 900 million?
0.
Thank you. 0. They would securitize the remaining 970 million, and in the prospectus in the risk section, there'd be a paragraph that would say, there might be some loans in here that are not so good. This was referred to, the Financial Crisis Commission discovered this. I remember they had a hearing in Sacramento that I watched live. I can't remember how. And when they testified to this, I think I turned to Vince and go, well, people are going to jail for this because this is unbelievable. And the Financial Crisis Commission actually referred this to the Justice Department for investigation. And as far as anybody knows, the Justice Department never even investigated.
Well, and none of the CEOs of the large banks went to jail either.
Nobody went to jail.
So this might be a good follow-up question to this gentleman's question. So looking back after, 17 years, and in the moment looking at the solution and the policy that was implemented by the government, Lehman Brothers can go bankrupt. We're going to let AIG go forward. Do you think the solution or the epilogue to this whole thing was proper? I'm not saying it was fair, but do you think it was proper?
Oh, I think the government had no choice. I sometimes like to play out in my head what would have happened if the government had done nothing. Almost every large institution in the United States and outside the United States would have been bankrupt. Goldman, Morgan Stanley, they'll be gone. And
So would all our money.
so would all our money. And, at the height of the great financial crisis, the Great Recession, it was 10% unemployment. It had been 30. It had been a Great Depression, unquestionably. The government had no choice, unfortunately.
Oh, hey, Steve. I was wondering, what's your perspective on the current CMBS market, given that issuance is actually at the highest level since the GFC, and spreads are tightening, but at the same time, we're seeing delinquencies actually rise close to 10% year over year for certain assets.
I have no opinion on the CMBS market. I literally haven't looked at the securitization market in years. So I just have no opinion. I wish I did, but I don't. Yeah.
Thank you, Steve. I was wondering when you are looking at specific sectors, for example, you talked about for-profit education and student loans. What are the warning flags that you are looking at that indicate that the business has serious structural problems versus just temporary problems?
That's a very good question. I mean, the for-profit education industry was really a structural problem because it was basically a very bad product that was just thriving because of the government. I'm actually fairly bullish about the U.S. economy these days. I mean, it's a bit of a K-shaped economy in that, everything is so AI focused. I do think that the U.S. economy is the most dynamic economy of any developed country. And I'll give you an interesting statistic that I just looked up the other day. So NVIDIA today passed $5 trillion, and Apple and Microsoft are just past $4 trillion each. The largest market cap of any company in Europe is not even 500 billion. So to me, if you're going to invest, you're going to invest here. I don't see any point in investing overseas.
Didn't European stocks outperform U.S. stocks right now, year to date?
They've outperformed for the first time like in 10 years. Every dog has its day.
I was going to ask, you always say in your podcast that you're bullish on the US market. And you always say that if there's something to knock it off is a real war, like tariff war with China. I was going to ask, given that almost 50% of GDP growth is AI.
I think it's more than that.
Yeah, I think it is more. I went with the safe one. Also, the recent developments with China showed that the US lacks with the rare earth minerals and all that stuff. Inflation is ticking up, unemployment is ticking up a little bit. Monetary policy is a bit shaky right now. Doesn't this show you a bit that the fundamentals are not so strong as we would expect? And there's an AI bubble that's pushing everything to keep going.
I think there's a lot of validity to that. I mean, I do think it's a bit of a K-shaped economy. I mean, it's unbelievably AI driven. And, the operative question is, what are the returns going to be for all this investment that all these companies are doing? And I don't think anybody has a good answer at this point because it's just too early. So you could say whatever you want. I've read a lot of people who are skeptics. I've read a lot of people who are not skeptics. I don't, at the rate things are going, we're not going to know one way or another probably till 2027. So until then, Meta, Google, and Microsoft all reported, and they're not stopping their CapEx. They all increased it a little bit. So the story continues until it's shown that it's not.
What about the job losses that are already starting to come to fruition, whether it's Amazon or UPS, 48,000 for UPS, 30,000 Amazon? It's starting to get scary. Every day there's an announcement.
No, I agree. I mean, it's very K-shapey. That's what's happening. Housing, as you know, sucks. The consumer's still spending. Visa, the Visa numbers were, revenue was up 12%, which for a company like Visa tells you the consumer is still spending. So, and all the banks reported consumer credit quality was fine. There has been some bankruptcies like this Tricolor and First Brands, but I don't see anything really bad yet. I really don't. Yeah.
Yeah. So
Going more on that point about how you are very bullish on the U.S. economy, it feels to me as if it's getting less and less diverse year over year. Like I'm only investing in almost half of 7 stocks at this point. And to that tone of the K-shaped economy, it feels as if these companies are leaving kind of the rest of everything else behind. They're leaving the average consumer behind. They're leaving the other stock prices behind, as you said about the European stock market. And it seems as if this is taking on a lot more risk than it used to, given how lacking in diversity the market is getting to be.
I mean, it's pretty top heavy. That's fair. I just think that as long as this CapEx continues, the market will probably still go higher. On the day that Meta announces that it's cutting its CapEx by 25%, the market's going to have a big correction. But I think we're quite a ways away from that. And the other thing I would just say is that there's a big difference between now and the internet bubble. You know, the internet bubble were all these companies that basically had no revenue and just raised all this capital. This is money being spent by the biggest companies on planet Earth out of their own cash flow. So they're not leveraging themselves to do this. They're just spending the money that they have. So that's actually to the good. But that doesn't mean that when one day they announce they're reducing their CapEx, that we won't have a problem.
I had 2 questions. Number one, what exactly do you mean by a K-shaped economy?
Okay, stop right there. So K-shaped means like K and then K, okay? So, you know, part of the economy is going up and part of the economy is going sideways and down. That's what K-shaped means.
And then my second question was, do you know if there was ever like a confession by like some of the people who helped, like not help create as in like intentionally, but like led to the 2008 financial crisis?
You mean like they went to church and they confessed to their priest?
No, I mean like if there was ever, if anyone has ever.
Nobody confessed.
Okay.
Nobody.
Thank you.
Good question. Oh, they're in the corner. David, shout it out. Go ahead.
I'll repeat it. Go ahead.
In one of your previous podcasts, you talked about how one of your favorite movies is The Man Who Shot Valance.
The Man Who Shot Liberty Valance. Yes.
It's beyond my time. And,
it's beyond everybody's time in this room, including me.
Everyone here wants to be the man who shot Valance. You have a consumer who's being under more and more pressure, especially when it comes to buying a house. You have this AI spend that may or may not turn into a bubble. And you have this growing deficit that may or may not get called if the U.S. Liquidity market ever comes into question. What can we do and where can we go to hopefully find Liberty Valance?
I got to tell about the movie. So The Man Who Shot Liberty Valance is one of the all-time great Westerns. It's not your typical like shoot 'em up Western. So it stars Jimmy Stewart, John Wayne, and Lee Marvin. Have you seen this movie? Okay. So Jimmy Stewart plays this like lawyer who shows up like in the Dakotas, which is back in the movie is a territory. And the political question is that they want to become a state or not. And he befriends John Wayne, and they're competing for like the girl, but they're friends. And Lee Marvin's the bad guy, Liberty Valance. And Lee Marvin takes a hate on Jimmy Stewart. And to make a long story short, and you really should see the movie because it's really spectacular, there's a duel. And Jimmy Stewart kills, by some miracle, Lee Marvin, who is a gunslinger. And Jimmy Stewart barely knows how to shoot a gun. And because he's the man who shot Liberty Valance, he becomes very famous, and he becomes governor of the state and senator of the state, and he becomes ambassador to England, and he gets the girl. And basically the movie begins, he's much older now, and he comes home because John Wayne has died, and so he wants to be at the funeral. And he's being interviewed by 2 reporters, and he tells them that he did not shoot Liberty Valance, that John Wayne had been standing on the side and shot Liberty Valance when they drew their guns. And so his entire fame was basically based on something that somebody else did. And then he leaves. And the two reporters are sitting there dumbfounded. And the younger reporter says to the older reporter, what do we do with this? And the older reporter says, and this is the great line in the movie, it's something like, in the West, when confronted with the truth versus the legend, print the legend. So, people think like I'm some unbelievable guy because I predicted a financial crisis. I'm not so unbelievable. There's less to me than meets the eye. So I sort of live this movie in a way. People think I'm the guy who shot Liberty Bay. Yeah, I shot him, but I shot him because I wanted to make money. Now give me your question again.
Where do we go to even find the town in which Liberty Balance is in?
Where do you go? So I'll give you my talent speech. Go back to when I was a lawyer and miserable. So my wife was a lawyer too. She was pretty miserable as well. So we went to this place that tests you for attributes. So what's an attribute? An attribute is not intelligence. An attribute is like, what are you naturally good at? So we went through a whole day of tests. And at the end of the day, they said to me, you generate a lot of ideas, but you are not detail-oriented at all. The worst thing you could be is a corporate lawyer. So now I knew why I was miserable. So what I say to young people is try and figure out what are your attributes. And think of it this way. Like I remember when I was in high school, I had some friends who were great at math and science, but were not so good in English and writing. Then I had other friends who were great in English and history and they were great writers, but they weren't great in math and science. So, figure out, not that you're smart. You all go to a nice university, you're all bright, but there's certain things that come easily to you and there's certain things that don't come easily to you. So if you want to pursue a career on Wall Street, first question you should ask yourself is, am I a math person or am I a story person? I'm a story person. If you're a math person, you probably should go to the fixed income side. If you're a story person, you should probably go to the equity side, because the equity side tells stories in numbers. In the fixed income side, they just do math.
Thanks, Steve. This was very, very helpful. Obviously, you had a very successful career, met a lot of successful people throughout your life and stuff. Obviously, the room's full of college students. I have a young son at home and stuff. What's some, whether it's personal investing advice, just looking back on your career, your life, you would kind of give somebody that's kind of entering the real world and about to embark on a career in the finance world?
What would be my advice to someone embarking on a career in the finance world? Is that your question? I mean, basically what I just said. I really would spend time. You don't want to be a round peg in a square hole. You don't want to be, if math is not your forte, you don't want to be in a business where it's all numbers. So, figure out what comes more naturally to you and pursue that. That's what I would say.
Dave, were you asking how maybe someone starting out should invest their own personal capital, or more what Steve responded to?
Yeah, but you can go that way. I was just kind of thinking.
Like if you're investing, you should be buying a house, you should be investing in the stock market.
I mean, I don't think housing is an investment anymore. I just don't. I'd be curious if you think that, but
If you want to be in line with inflation, that's kind of the best case, right?
Right. So, I would just take some money, not more than I can afford to lose, and start to dabble and figure out what works. That's what I would do. Yeah, back there.
Hi, I wanted to know, given your past skepticism and trepidations about cryptocurrencies, particularly on the point that they lack.
I have a confession. I own a little crypto.
Okay.
But just a little.
Most people do, yeah. But it's, in the past you've said that the issue is that they lack any real intrinsic value. I wanted to know axiomatically, have you changed your stance on that given that the regulatory framework around cryptocurrencies are seeming to mature, and also that a lot of financial institutions seem to be integrating that, perhaps not real asset into their establishments?
It's a very good question. I used to think about, is it really a currency or not? And, at this point, that's like, there are enough people in this world who actually believe in it, so it does, what I think about it doesn't matter. My issue with crypto is not, is it an asset class or should you own it? Like I said, I bought a little myself just so I'm there. My issue is that, when you talk to the cryptomaniacs, let's call them, and you ask them, like, why do you own crypto? Like, why? What's the rationale? There has to be a rationale. They all basically have the same rationale, which is that, all this government spending that has taken place has debased what's called fiat currency, meaning government currencies. And so you should own some crypto as basically a hedge against the debasement of fiat currency. That's the most common thesis. So my response to that is, okay, I'll grant you the thesis. Here's my issue. If that's your thesis, then on days where everybody's petrified about inflation and interest rates are going up and NASDAQ is going down, crypto should go up. And on days where NVIDIA is rocking and rolling and there's no inflation, everybody's feeling good, crypto should go down. But it acts inversely to its own thesis. In other words, the correlation between NASDAQ and crypto is unbelievably high. So I still, now the people who love crypto say, yeah, but it's a young asset class, so it acts however. So, okay, so yeah, I don't know what to do with that. That's my problem with crypto. So the question is, do I think AI will eventually pick up stuff in underwriting that, let's say, current old models won't pick up? I mean, the current models are all based on FICO scores. Will AI improve? I don't know. I don't have really a form of opinion about it one way or another.
Just leveraging off the AI question, thinking about, do you think that Wall Street will see significant job losses because of AI, like equity research analysts? Because I have a student that asked me that question, so I'd love to know your answer.
I mean, the gossip is that, the number of junior investment bankers will be less. Maybe the number of junior analysts will be less. I don't know. Somehow people manage to get jobs. I just don't know. I don't have a strong opinion about it one way or the other. Yeah.
That was going to be part of my question, so I'm just going to switch it. But thank you again for being here. You are a great storyteller, and so I'm curious, did you get influence on who told your story in the movie?
I'm sorry, did I what? Did I have any influence?
Yeah. Did you say, yeah, okay, I approve Steve Carell?
No, not at all. What happened was, Michael Lewis wrote his book, and then he sold the rights to Brad Pitt's company. And some guy wrote a script and nobody really liked it at first, and it was like dead for years. And then I think sometime in like 2014, Michael called me to say that Adam McKay, who had been the head scriptwriter at Saturday Night Live ages ago, had rewritten the script and was going to direct the movie, and that he was going to call me. And I said, okay, Michael, great. I figured that was nonsense. And then a couple of weeks later, Adam McKay called me to say that he wanted to meet me, and that they were going to be making the movie, and that there was a very strong possibility that Brad Pitt was going to play me.
Thumbs up.
To which I responded, the only thing I think Brad Pitt and I have in common is we both have good hair. I had more hair back then. And then it turned out Brad Pitt, for scheduling reasons, couldn't play me. And so Steve Carell played me. But I had absolutely no role at all in making that movie. None.
Thanks.
But you were on set. You were there, right?
Well, I was on set. Maybe I'll end just with my one contribution to the movie, which is a word. So there's a scene in the movie, it's pretty near the beginning. So Steve Carell is talking to his wife, Marissa Tomei. I love saying that. Yeah. And my wife actually looks a lot like Marissa Tomei. I'm quite blessed. And so it actually was filmed on Houston Street in the Village. And so he's walking on the street and he's talking to his wife. And at the end of the conversation, and so my wife and I and my kids were invited to watch this scene. So He's talking to his wife, and he's about to hang up, and he hails a cab. And so they have a cab pull up. And as he's about to hang up, they have this extra basically try to brush past him to steal the cab. And the way the scene was originally written, Steve Carell basically confronts the guy and says, "Hey, that's my cab, asshole." Cut. So at that point, Steve Carell walks over onto the sidewalk because Adam McKay is there, and they have like a little TV, and they want to rewatch the scene. So my wife and I, my kids, were standing on the side, and I say to my wife, Valerie, "I got to say something." And she says, "Don't say anything." And I said, "No, I got to say something." And she says, "No, please, I'm begging you, don't say anything." I said, "No, I'm going to say something." And I walk over to them and I go, "Hey guys, I think if it were me, I would have said schmuck." And schmuck's in the movie. And that's my only contribution to the entire Big Short movie.
Thank you, everybody.
Thank you.
Honorary sweatshirt.
It's been a real pleasure. I wish you all the best of luck in your endeavors. And I'll hang out if anybody wants to ask any questions for a bit.
Thank you, Steve. Really appreciate it.
This podcast is for informational purposes only and does not constitute investment advice. The host and guests may hold positions in stocks discussed. Opinions expressed are their own and not recommendations. Please do your own due diligence and consult a licensed financial advisor before making any investment decisions.